With oil closing nearly $46 a barrel in New York last week, OPEC appears to have finally lost control of the oil market narrative, and traders appear to have given up on the early rebalancing of the crude market. Prices are now flat and calendar spreads are plunging to their lowest level since OPEC signed a 6-month deal to curb production in November 2016, and meanwhile shale drillers are pressing ahead with their longest expansion since 2011. US rig counts continue to climb, adding another 9 rigs in the last week of April, putting the oil rig count just shy of 700, or up 120% since its low last year. Aside from a handful of exceptions, the rig count has grown almost entirely uninterrupted week after week for the past 12 months, even during bouts of lower oil prices. Oil rig counts are rising, but so are costs, and the reality of the limitations of shale may start to become painfully obvious. While the number of active rig counts increases, so does the cost of these wells, which increased by 7% between November and March according to Bureau of Labor Statistics. This is the first significant increase in drilling costs in the last 3 years, and with the rapid increase in drilling rigs, oil service and labour costs will go higher. Unsurprisingly, the increased rig count has led to a sharp resurgence in US oil production. The most recent estimate from the EIA puts the total US production at 9.3 million barrels per day, or up 700,000 barrels per day from September 2016. Some of these additions came from long-planned offshore projects that came online in recent months, so it's not entirely from US shale, but that suggests that even stronger production gains could be forthcoming since the shale industry is only now getting going. Then again, there are also unexpected gains from elsewhere in the world. Libya, which is exempt from OPEC's share plan cuts, has doubled its production since September to 700,000 barrels per day. More ominously, it's also planning to ratchet up production to 1.2 million barrels per day by the end of this year, and whilst that goal may prove fanciful, it highlights the fact that Libya could be as much an upside risk as a downside one. The return of bearishness is also borne out by the latest trends in the futures market. According to data cited by Bloomberg, major investors cut their bullish bets by 21% since the end of April, and speculative movements in the futures market, whilst they don't dictate everything, are good indicators of market sentiment. So what therefore of the future? Well, the fact that the oil glut persists despite what should be bullish trends, high OPEC compliance, growing demand, and initial sign of falling inventories suggests that lower prices could be forthcoming. For the next couple of quarters, there seems to be nothing to indicate a strengthening market is close to hand, and OPEC almost certain to continue their cuts come their May meeting. Can the case be made for bulls on the horizon? Well, US production is around 330,000 barrels a day, up from last year, and that's just a small part of the 1.2 million barrels a day that OPEC cut, and before you even factor in the additional 500,000 barrels a day that non-OPEC members cut. On top of that, as drilling costs rise, the break-even on shale may slow the amount of projects and may make some banks think twice about extending money to drillers who are pumping more oil but losing more money on every barrel. Looking ahead, we should start to see a large drawdown in US supply as the impact from traders dumping oil from floating storage and sales from SPR start to subside. At that point, the market may wake up to the fact that we are entering a potential area of global supply deficit for the first time in over a decade, and questions must arise over Shell's ability to fill that void.